I'm Taylor Riggs in San Francisco. This is Bloomberg Technology. Coming up in the next hour, demand in doubt after Tesla's third quarter deliveries failed to match up to Elon Musk's forecast. Analysts reevaluate the stock price. We have the latest. Plus, diversity and inclusion. Former interim Reddit CEO Ellen Pao on corporate governance in the tech sector. And new Threads. Instagram introduces a mobile app called Threads. It's designed to share content with a smaller circle of friends, but it looks a lot like Snapchat messaging. We have the details. But first, our top story. It was a bad news, good news kind of day for Tesla after releasing third quarter delivery numbers. The electric car maker delivered a record 97,000 cars, but founder Elon Musk had hyped the idea of reaching 100,000. So instead of rising, Tesla shares sank after the announcement. Earlier, RBC analyst Joseph Spack joined Bloomberg to look ahead to that earnings following the delivery numbers.
We have them falling short of their guidance, and even if you look at sort of the production levels, right? There was, as you mentioned, sort of some record production levels. 96,000 some odd units. There would need to be sort of a significant increase in that. I think there is some hope that the Shanghai factory would be able to come online and add some capacity there, but we remain skeptical on that front as well.
With more, I want to bring in Gordon Johnson of GLJ Research, and also with me, Bloomberg's Dana Hull, who covers the company for us. So, Dana, let me start with you. We've talked a lot about the delivery numbers, and I'm curious more about that composition mix. What do you make of the Model 3s versus the S and the X and that price differential?
Sure. So the Model 3 made up about 82% of deliveries in the third quarter. And this is a concern. I mean, it's great for the Model 3. People love their car. But it's a concern for investors because the margins on the Model 3 are lower than on the S and the X, which are higher priced. And those deliveries have been sort of falling down.
Gordon, what do you make? Is the biggest concern for you the fact that they're selling more of the cheaper cars and that's pressuring margins?
Well, I think mix is definitely a concern, but I think the biggest concern for us is the street is expecting their 3Q revenues to grow. But if you look at the fact that from 3Q 2018 to 3Q 2019, ASPs are down roughly $10,000, and they sold roughly $13,000 more cars. Doing the math and also considering the leases increased significantly, they only recognize 1/12 of the lease revenue for the car in the quarter they sell it. We think revenues are going to be down year over year, and this is a growth story. So if revenues are down, it could potentially turn into a busted growth story.
Gordon, how do they boost revenue growth then?
Well, we don't think they do. And, I think what's very significant is if you look at the European sales, specifically Norway, the Netherlands, and Spain, and you look at the mix of Model 3 sold in Q3, the mix of Model 3 long-range all-wheel drives dropped significantly from Q1 to Q3, and the mix of Model 3 SR Pluses increased significantly. The problem with that is there's about a $10,000 discount of SR Pluses versus long-range all-wheel drives. So you're going to get a very negative mix impact in this quarter as well. So we think the street is, the street's at roughly a $200 million loss. If you do the very simple math, we're coming to a close to $400 million loss. So while Elon Musk has gotten everybody to focus on production, we think you need to focus on profit, and we think that's a problem.
So, Dana, you've heard Gordon talk a lot about ASP, that average selling price. From your reporting and what you hear on the street, is there a composition of the S and the X that they need to sell in order to finally get that profitability that seems ever elusive?
Well, I think the thing to remember is that Tesla has other levers that they can pull and to pad their balance sheet. They make a lot of money selling regulatory credits to other automakers, and the accounting for that has always been a little tricky to decipher, but they could recognize more ZEV credit revenue or, more regulatory credits in Europe. They also have deferred revenue from full self-driving, and how they realize that revenue as they roll out more features is another sort of thing that they can pull on going forward.
Gordon, you could argue that this company, frankly, just has an expectations problem. I want to pull up a quote that we have from Gene Munster over at Loop Ventures. I spoke with him yesterday, and he said that when a company talks about delivering 100,000, you're hoping for 102,000. You're not expecting 97,000. This is a credibility hit, classic textbook example, frankly, of just not managing expectations. Is that this company's biggest problem?
Well, we don't think it's the biggest problem, but it's kind of funny that this is the time that people are looking and calling for a credibility issue. I mean, coming into this year, they said they were going to be profitable every quarter. They've already burnt up to close to $1 billion. I mean, they talked about funding secured. They talked about selling hundreds of thousands of cars. Look, I think the biggest problem here is Tesla is not making money, and it looks like it's going to be even worse in 3Q. And to Dana's point, there are things the levers they can pull, but if you look at the $408 million loss in Q2, and you think about Q3 and the fact that ASPs are down $3,000, even if you assume $200 million in ZEV revenues and full self-drive revenues, and you give them credit for no restructuring, you still come to roughly a $400 million loss if you assume their ASPs are down $3,000, which I think is fair. So even with those levers, I think it's going to be ugly this quarter.
Dana, from a demand perspective, how is the U.S. market? Is it mature?
You know, it's hard to say because so much of the growth of Tesla has been kind of viral. You know, someone gets a car, they let their friend drive it, then the friend drives their car. A lot of families have more than one Tesla in their fleet. And here in California, I see more and more Model 3s on the road all the time. But, you know, California is just one state, and there's plenty of states that Tesla's Model 3 has yet to really penetrate. It's like electric vehicles do very well in certain climates and in certain states, but it's not like a 50-state market yet.
Gordon, is demand in Europe and China the next leg of growth for this company?
Well, that's definitely what people are focusing on. But if you look at what's going on in Europe, if you take out the Netherlands, where there's a incentive that's being cut, and you take out the UK, where there's a lot of back demand that's being filled, growth there was down in Q3. And if you look at China, Tesla's Shanghai factory is looking to produce 150,000 Model 3s out of the gate. Right now, demand for their cars in China is trending at about 30 to 40,000 annually. So there's a huge gap. Tons of competition. They're not the number one player. They're not even in the top 10. The top two cars are priced at $20,000 versus the entry price for their Model 3 in China at $48,000. So it doesn't look like there's any respite near term for them in China. So we think they're going to have to find the significant growth that the stock's priced at somewhere else.
Well, Gordon, let me push back a little bit because the company came out and said they're entering the fourth quarter with a backlog. Does that not show a sign of demand?
Well, no, keep in mind, what Tesla has been great at doing is, keep in mind, they started marketing the Model 3 as a $35,000 car, full self-drive, that was going to be able to drive you from coast to coast in the U.S., so other people saw that. So they built up a big backlog over years. And now that they're unleashing that car into other markets, they're just basically executing on that backlog they've built over years, which is why I said you have to adjust the UK out of your EU numbers when you're looking at tangible, fungible, organic growth. So the backlog does not suggest demand. We think it suggests that they're entering new markets. Once we get past and go through that backlog, then you'll have the real organic growth levels. And as we're seeing in the U.S. Q3, their sales were down 22% year over year. Ford was up, I think, 5%. GM was up 6%, and I think Fiat was flat. So we're already seeing the negativity of the actual organic demand for their cars in the U.S. and the growth rate in Q3.
Dana, biggest talking point that you want to get from earnings?
Well, we need to know, are they going to reaffirm their full year guidance? And what are they going to recognize any of this deferred revenue?
Lively conversation. Gordon Johnson, CEO of GLJ Research, and Bloomberg's Dana Hull. Thank you both for joining me. And more news out of WeWork. The new company leaders told staff that job cuts are coming as soon as this month. WeWork's cost-cutting efforts would include layoffs. That's according to attendees of the closed meeting. The new co-CEO stated that the cuts will be handled as humanely as possible. We will cover this in detail with venture capitalist Bradley Tusk. That's later this hour. And coming up, from driving growth to changing governance, we look at why startups and investors are taking a fresh approach to diversity and ethics. This is Bloomberg. how startups are run and they approach diversity. It's increasingly in the spotlight. WeWork is the highest profile example. Last month, co-founder Adam Neumann was forced out as CEO and the company shelved its plans for an IPO. Both actions were taken partly to calm investors' corporate governance concerns. Joining me to discuss the importance of diversity and ethics at startups is Ellen Powell, founder and CEO of Project Include. She's also the former interim CEO of Reddit. On Friday, Ellen will speak at Tech Crunch Disrupt, making the case that running an ethical tech company means a better bottom line. Ellen, thanks for joining me. I first wanted to start with sort of that corporate governance problem that's come up so much recently, particularly in the example of WeWork. How do you measure a board's corporate governance? Is it the fact that they need a female on the board? What does good corporate governance look like to you?
It's an interesting question because I think we've strayed very far from what it started out. When I was in law school, we talked a lot about like all of the people that you're supposed to treat as your constituents, and that includes not just the investors, but also employees and your community and the public at large. And I think we've moved from serving the public and taking care of employees to just a focus on wealth generation. A lot of that comes from some changes that started with Google. When they started their corporate formation, the founders had a huge super vote for each share of stock that they had that gave them control of the company. I don't know if it still goes on to this day, but they've had, super voting control of all sorts of different issues, and that has come down to a lot of startups that have formed since. So my understanding is WeWork had maybe 20 votes per share for the founder and CEO, which made him the ultimate decider of many things. And when you have a board that can't really do that much because the founder has so much control, you wonder if that's actually going to be effective at all.
Are the markets or companies doing a good enough job of making boards diverse enough early on? You can't just do it right before you're about to go public. What's happening 5 years previously?
Yeah, I think there's a problem both at the board level and at the executive level where, it's this ongoing problem in tech where VC firms have very few women, they have very few people of color, and they have a tiny, tiny fraction. You can count the number of women of color, especially from underrepresented groups. And a lot of times those early boards are formed by investors, and it's the senior partners and the managing partners who get to sit on the boards and make these decisions. And often they are very homogeneous. They are talking to people who look like them and who don't experience a lot of the things that people from different groups experience. They don't have exposure. They live in a bubble. And when you have a board that is very homogeneous, they often miss big things. And if you look at a lot of companies and their problems, they are, because they don't have other voices, they don't have other perspectives, they don't understand that, hey, people who are renting on Airbnb might be from different groups, and there might be some racism if you have pictures, and how are we going to address that? And they end up addressing it much later, as you say, like 5 years later when they start getting scale, and then they have to rebuild their whole system.
So then what does an ethical tech company look like to you?
Oh, it starts from the very beginning when you're hiring the first engineers, when you're hiring the first marketing people, when you're hiring the first, when you're building your company, you have to think about, like, am I looking at all the right places for my team? Am I only hiring from my friends? Am I only hiring people who look like me? Am I only hiring people like from my fraternity in the early days? So, like, finding people who are coming from different experiences, finding people who are coming from different backgrounds so they have different perspectives is really important from the very early days. So at Project Include, we have programs to help encourage early stage startups to really look and measure and hold themselves accountable for the diversity on their teams, and to make sure that they're including those people from different groups in a way that everybody's having a good experience.
What do the numbers actually show you about the bottom line of companies that have diverse and inclusion versus those that do not?
Yeah, I think like McKinsey and Lean In have done a lot of work to show that companies that have racial and gender diversity, I think, are 35% more likely to have better financial results. So that's a huge percentage. If I'm running a company, I would much rather have those odds be better by 35% than not. And I just don't understand why companies are not reading the research and internalizing it and bringing together more diverse boards and more diverse management teams.
Well, you are part of that change. You're an investor yourself. As you take a look at the companies in which you're investing and the VC pipeline, how diverse does it look? How involved are you in the day-to-day to make sure that's included?
Yeah, for me, it starts at the investment level. Like when I'm thinking about investing, I talk to the founders about diversity and inclusion and whether it's a priority, especially if the team doesn't have much diversity in the founder group to start. And I only work with people who are interested. If they're planning on going the way that we've gone for the past 5-6 decades in tech, like, great, there are plenty of people who can help you, and there are plenty of people who would be happy to. For me, it's less interesting.
Just from a broad perspective, we take a look at a lot of the IPOs that have gone south this year. What's the pressure to be profitable, especially to start up these days?
I think with the recent IPOs kind of imploding or not being able to get out or going down a significant amount, people are all of a sudden realizing the markets are not rewarding your customer base, for your customer base. They're actually looking for a long-term strategy and long-term business model. And that is driving more investors, I think, to look earlier. Like, we can't just ride out a big set of growth numbers. We actually need to look at the dollars and the cash flow and the actual profitability. And that is changing how I don't see the whole swath of investments, but from my perspective, people are getting a little bit more focused on, like, what are your revenue numbers, what is your business plan for getting to profitability, and how are you going to be able to be a long-term business?
Well, and a lot of the other concerns have been about valuation. As you take a look at the investing landscape, do things feel overvalued to you?
They've felt overvalued for a long time, and I think you look at these last companies where they're raising billions and billions of dollars. It's incredibly, it's just felt very frothy, but I think it's been on this pace of growing valuation for many, many years, so it doesn't feel like there was a sudden jump to this hugely frothy valuation. It's been this ongoing climb, and now I think it's finally come to the point where maybe the bubble's going to burst.
Finally here, companies like SoftBank, big money coming in, have they structurally changed the environment, or can you still compete?
That's a good question. So I invest at the very early stage when it might be just 2 founders, or it might just be 5 employees. And I think everybody's kind of trying to expand what they cover. So, people at my level are trying to raise funds so that they can invest in the next stage when they see which of the early stage startups are actually making huge gains, and I can double down and put more money in because I wasn't able to get that much ownership because the valuations are so high. And now you see firms saying, no, you shouldn't work with individual investors. You should only work with firms, because firms are going earlier and earlier so they can have that kind of bird's eye view into what's working sooner and get into them with an advantage because they have the relationship. So things are still changing. So it's not clear. I hope there's still room for people like me, because the firms that are out there today are very homogeneous. And if you don't allow new players to come in, it's going to stay that way.
Well, we look forward to your panel tomorrow at TechCrunch Disrupt. Thank you. That was Project Include founder and CEO Ellen Pao. Coming up, Amazon is said to plan an $800 million data center in Argentina. How the tech giant could be reaping big tax benefits from the expansion. That's next. This is Bloomberg. Amazon's cloud division is expanding. According to sources, the company plans to build a regional data center in a free trade zone in Argentina. Amazon is preparing to invest about $800 million in the project over 10 years and will reap considerable tax benefits. For more, I want to bring in Bloomberg Technology's Spencer Soper, who covers Amazon for us. I have to ask, why Argentina?
Well, this will be Amazon's first data center in South America since its first one in Brazil back in 2011. And so now this one is nearby in Argentina, the second biggest economy in South America. And so it's just expanding its presence in Latin America for the first time in several years.
Spencer, when I was in New York, Amazon was looking at expanding their second headquarters, and they got a lot of pushback because of the tax breaks. Is there any risk that Amazon gets backlash because of the amount of tax breaks in Argentina?
I haven't heard much on that, and a lot of these are fairly standard for the trade zone down there. So a lot of them, it would be any business operating in this specific trade zone will get those benefits. It's something that the Argentine government put in place to try to grow more tech companies, entice more tech companies and other knowledge-based economy players into that area. So it seems like it's pretty standard. The big benefit they're going to get is there are some breaks on energy use taxes, and because data centers consume so much energy, that will be one thing that is particularly advantageous for Amazon. But most of the benefits seem to be pretty standard for any business going into those trade-free zones.
Spencer, you talk about how companies want to be close to those data centers because they can get the extra high speed, for example, that comes with being in the same country. What other tech companies outside of Amazon could take advantage of this program and are poised to benefit?
Well, the cloud computing industry is about $200 billion globally, and it's growing at close to 20% a year. So Amazon's racing to build data centers around the globe, as well as Microsoft and Google. So you basically have this race to create capacity and be close to customers to give them the best user experience. And it's not just the customers, that are physically based in that country that benefit. Any global platform that has that is serving its customers through the cloud, that has end users in those countries, would also benefit. So a platform that serves its South American customers through a data center in Argentina would have a better user experience than if those customers in South America had to access those services, through data centers in Europe or the U.S., as many do now.
So, Spencer, it sounds like this could be the first stop of many for Amazon as they look to expand their global cloud center. Am I right?
Yeah, there's a big investment in cloud computing, and they've got them in the U.S., they've got them in Europe, they've got them in Asia, Australia, I think South Africa is on the map. So yes, they're absolutely just trying to continue to build capacity and see no slowdown in this demand as more and more companies see the benefits of having on-site data servers and on-site staff to maintain and manage them, to simply outsource that to someone else and gain all of those efficiencies. Amazon, this is just another indicator that Amazon sees this business to continue growing.
Bloomberg Technologies' Spencer Soper, thanks for joining me. And coming up, in one corner, the king of social networks, in the other, the presidential hopeful. They are ready to go head-to-head. That's next. This is Bloomberg. Bloomberg Technology. I'm Taylor Riggs in San Francisco. Who's afraid of Elizabeth Warren presidency? Not Facebook CEO Mark Zuckerberg. At least that's what we learned from the leaked audio obtained by The Verge earlier this week.
If she gets elected president, then I would bet that we will have a legal challenge, and I would bet that we will win the legal challenge. So does that still suck for us? Yeah. I mean, I don't have to, have a major lawsuit against our own government.
Joining me to discuss the regulatory impacts this could have on Facebook, Bloomberg Intelligence senior analyst Jitendra Woral. Jitendra, so let's just start sort of broadly here. What are these regulatory hurdles having an impact, if any, on Facebook's bottom line?
Yeah, so the demand aspect of things, you look at the platform usage, you look at what the advertisers are doing, that has not really changed. But what's definitely changing is the way Facebook is able to take advantage of this demand and its long-term prospects in a way. And that's happening because of a few reasons. So it doesn't have an impact on business strategy, product delays because of regulatory hurdles. Then you have lower ad targeting potential and its impact on the future. Compliance costs increasing because of regulatory requirements. So if you look at the long-term expectations, they're not getting the credit in terms of what they can actually achieve through diversification of revenues or really their strategies that they have at hand. And regulations are really playing a role to sort of roll back some of that longer term.
I want to start with the cost side of things before we go to the left hand of the income statement.
Yeah.
So on the cost sides, compliance costs seem to be, they could be millions, billions. I mean, you name it. Do you have any impact of what the actual compliance costs are and how that could impact in, say, the next 12 months?
So it has already had an impact on Facebook. If you look at their margins, they have declined. The expectation is that the cost will taper going into this year with the election cycle. We don't know if it's going to hold or not. But structurally, the cost structure of doing business in today's environment has changed, and that is not rolling back. Now, what will be more interesting is if you actually look at expectations for growth for this company for the next 3 years, 20% revenue growth is what the market is expecting, give or take, barring a recession. And if you look at that growth and align that with end market growth, what you'll notice is they're only getting credit for what mobile advertising and things like that are doing, where they just have to slightly marginally grow their market share to achieve those numbers. But if the other initiatives like payments, e-commerce with Instagram checkout, they have massive potential. If they are able to navigate the regulatory hurdles and pick their battles and diversify into that, then you have the upside on that consensus. So that's the reflection, what you see in expectations in terms of this visibility of execution.
Well, and as you talk about revenue growth, almost amazingly, Facebook has gone ahead and done some more acquisitions. They've launched new products. To me, it feels like they are full steam ahead, full business plowing through. So we haven't actually seen them sort of slow down on any product launches or any acquisitions, have we?
Well, their ability to capture the market, through payments. Payments is a great example. You're seeing the challenges Libra is facing. That definitely sort of at least delays, if not derails, the long-term prospects that can have from those avenues. So I think it's more to do with how these strategies, which were supposed to pan out sooner, will pan out later, and what sort of impact it can have on their revenue growth. So hopefully second half earnings results will shed better light on that.
We talk about a conglomerate discount. Is there a regulatory discount of companies that are facing big headwinds, that are trading at a discount relative to, let's say, a Twitter, which has been sort of out of the headlines when it comes to all the regulation?
That's a great question. Absolutely is the answer. And I think it's showing in Facebook's valuation right now. I mean, it's trading at levels closer to its lowest ever seen levels. So that's sort of reflecting some of that. Now, obviously, if you look at the near-term expectations, I mean, there's not a lot of risks to that. But these longer-term expectations, which, like I said, it's mostly giving them credit for what the end market is growing at. It doesn't really factor in what happens if Instagram checkout does succeed. What happens if payments, even if it's not Libra, if it's partnership with PayPal that pans out via e-commerce or other avenues, those elements are not factored in consensus yet, and that's the discount that you're seeing in the market.
Quickly here, is Facebook doing a good job being proactive with regulators instead of reactive, which is what they were maybe a year ago?
They're taking a lot of preemptive steps here. From a regulatory standpoint, there's a lot more work left. And we'll keep seeing regulations as an ongoing challenge for Facebook. But if they're able to pick their battles and focus on avenues like Instagram checkout, like I said, they can change that long-term conservatism that we see in some of these estimates.
Bloomberg, Jitendra Boral, thank you for joining me. And sticking with regulators going after Facebook, the social network may be forced to censor online hate globally. That's the result of a ruling by the European Union's Court of Justice. The court says European judges can order Facebook to remove offensive and defamatory posts by users in the EU. Courts could also order a worldwide removal as long as they take international law into account. Facebook said the ruling goes beyond a process it already follows to, quote, restrict content if and when it violates local laws. And sticking with more on Facebook, the company is taking on Snapchat once again. Its Instagram subsidiary just introduced a Snapchat-like messaging system called Threads. The new feature is supposed to be a quick way to share content with your closest friends on Instagram. This would be the second time that the photo platform has borrowed from its rival. Shares of Snap dropped on the news at one point, down more than 7%. Joining me to discuss, it's Jefferies analyst Brent Thill. He currently has a buy on Facebook and a hold on Snap. So, Brent, what do you make of this new product?
I think it's another feature set for Facebook to help engagement. We don't think it's the death of Snap. We've done a ton of work talking to teenagers that love Snap and aren't going to get off of it because they added this feature. But it's just one of the additional add-ons that Facebook can build on top of their platform to help engagement, keep users there, and potentially eliminate the need to open another app. So today, I don't think it's going to have a major impact on the Snap's user base, especially considering it's a younger demographic. They have the heat map of where all their friends are at. They have all the content that they're used to. But for an older demographic, we think this will be interesting to be able to share private messages on the platform with your friends and you're in a closer circle rather than the rest of the world seeing. So a nice feature set, but it's not going to move the needle dramatically for Facebook, in our opinion.
Brent, though, to push back a little bit, isn't this Facebook's way of admitting that they know that Instagram growth is slowing and they have to get a new product out there to keep growth expectations in line with where the market thinks they should be?
Advertisers are flocking to Instagram right now. The whole shopping app is blowing the doors off when you talk to advertisers. We don't think growth is slowing materially. We do think this is a nice feature add-on, but this is certainly, from our perspective, again, not going to be a needle mover. Just like when Libra came out, everyone says, "Oh my, it's a watershed moment for currency. It's gonna reshape Facebook." We think this is incremental. So I don't look at this and say the growth is in a massive free fall. We still think that this company can generate 30% top line growth and a mid 30% operating margin, which in tech is a really good number when you look at the balance of top line and bottom line growth.
Do you get nervous, though, that Facebook, this is the second time that they're copying Snapchat? They're not innovating, they're just borrowing?
I think it's definitely, they're able to kind of fast follow, if you will. So if something's popular somewhere else, they can add it on. But I just look at the breadth of solutions now that they have in the core Facebook redo, what's happening on Instagram, what's happening with shopping, what's happening with messaging. There's a tremendous amount of features that they keep layering on. And this is analogous to Microsoft. Microsoft copied other vendors, but over time was able to eliminate some of these vendors because the power of the suite, the power that going to one app has. Uber's going to do the same thing when they fuse driving, food delivery, and an AI engine saying you get up and you got to go to work. Would you like a car delivered to your office or a home? We think the entire industry is going this way. More features, brings you back, keeps you on the platform, and no one wants to install another app right now on their phone. So I think it's a smart move. I don't think it's a sign that they're running out of steam.
So on the Snap side of things, would you defend the stock at these lower levels after the price reaction today?
We have a hold on Snap. The stock's had a great year. We think fundamentally they've really turned things around. We thought the sell-off earlier today was overdone. It closed down roughly 3%, so we think it kind of came back. But again, fundamentally, we continue to believe in that story and believe they're on the right track. So we like Facebook better than Snap, and we think Facebook stock's going a lot higher. So we would prefer owning Facebook at the current levels.
Very interesting. And as we approach earnings season here, what do you need to see from the Snap side of you to change from a hold to a buy? Do you need more confirmation that the face swap filter has more leg room to run?
No, I mean, it's more just multiple. The stock's had a huge run. The multiple has gone from 2 or 3 times at the trough, upwards of 10 times now in forward revenue. So you're at the higher end of the valuation. And so fundamentals now have to follow through. So no big change in terms of our thesis. Great story. We continue to recommend holding shares. But again, we're buying more Facebook here rather than Snap.
You heard it there. Buying Facebook more than Snap. That was Brent Thill of Jefferies. Thank you for joining me. And still ahead, back in the fold, Microsoft dials back into the phone market. Can it keep from repeating the past? We discuss next. This is Bloomberg. A 3-year-old Indian startup has raised $585 million from investors, including Tencent and GGV Capital. Udon, it's an Indian e-commerce marketplace for businesses, has now raised $870 million since its inception in 2016. Bloomberg's Harsha Subramaniam has the story from Mumbai.
An Indian e-commerce marketplace called Udaan has raised $585 million from a bunch of investors, including Tencent Holdings, Altimeter Capital, City Ventures, and GGV Capital. This Bangalore-based startup sources directly from small manufacturers and farmers to supply to neighborhood stores, restaurants, and even street vendors. Udaan was founded by 3 young engineers under the 40 years of age who graduated from the Indian Institute of Technology and worked at online retailer Flipkart before. This 3-year-old startup connects 20,000 sellers from across the country to 3 million retailers in categories from fruits and vegetables to electronics and even apparels and toys. One of Udaan's founders, Vaibhav Gupta, in an interview to Bloomberg News, says the new capital will be used to enhance the technology platform, grow more categories, and build their payments and delivery capabilities.
That was Bloomberg's Harsha Subramaniam reporting from Mumbai. Now, Microsoft, they're back in the smartphone business, but gone is the failed Windows phones of yore. In its place is the new foldable Surface Duo. It's an Android device that Microsoft hopes won't repeat the past. Remember that Microsoft dropped $10 billion to buy Nokia's handset business back in 2013. It was a move that didn't work out for then CEO Steve Ballmer. So, can Satya Nadella's Microsoft avoid the same fate? To answer that, we go to our own Mark Gurman in Los Angeles. Mark, why now?
Yeah, no, that's an interesting question. I mean, I think the mobile industry is at a point where we're sort of shifting from smartphones, the way we currently understand them, things that look like the iPhones, to a new category. And that's either foldables or moving to glasses and stuff like that. And what Microsoft is doing here is they're saying, you know, we have a new category too. So they're not coming out with the classic interpretation what the smartphone is. They're doing something themselves. They're doing something interesting. We won't know how it's going to fare until the end of next year. It's not clear if consumers are actually asking for this, if anyone's going to buy it. But the fact, to your point, that they're running on Android versus, you know, Office or Windows software actually means they actually have an opportunity to do something here.
Yeah, so that opportunity, smart move to have Microsoft apps and Android apps that can lay on each other on the foldable device.
Yeah, they really had no other choice. This thing would be DOA if they went with Windows here. People do not want Windows phones. It has a horrible reputation. It didn't last long. The whole Nokia purchase in 2013 was an utter disaster, and you saw they had to write that whole thing off. So right now, the smartphone landscape, it comes down to iOS and Android. Obviously, they can't use iOS because it's a closed ecosystem. Android is the other option. It has 65% right now of the US smartphone market, and so they had to do it. And this was, I think it was actually a sort of a bold but also obvious decision on Microsoft's part. Obvious because they had to do it, bold because, hey, they're putting Google software on a Microsoft product, even though Microsoft at its core is a software company.
Mark, I love the title of your latest column. It's called Microsoft's Non-Phone Just Out-Innovated Apple. Walk me through your thesis.
Yeah, so I mean, that perspective is basically when Apple held their big event earlier, actually it's September now, we're already in October, they called it, the buy innovation only event. And, the definition of innovation is something really new, right? In Apple's case, they came out with a lot of stuff that is going to sell incredibly well. They came out with better battery life, better cameras, things that people want, but they didn't really introduce anything wholly new. In fact, they haven't really done anything new in 5 years since the Apple Watch was announced. But we have Microsoft here, a company known as by some as a technological dinosaur, is actually out here trying new stuff. Apple's at the point where they need to try something new, whether that's something in the auto industry, whether that's something in the home, whether that is more advanced AirPods with cellular connectivity that can rely on their own. But of course, the holy grail for them is this AR/VR headset, which will come in the next few years or so. But it's very clear. Microsoft, Samsung, Amazon, they're all trying new things, while Apple is sticking to its tried and true recipe that generates a lot of money, but maybe not so much excitement.
Bloomberg's Mark Gurman, thank you. And coming up, lessons from WeWork and Uber on trying to go public in today's IPO market. We get insight from venture capitalist Bradley Tusk. This is Bloomberg. We mentioned earlier this hour that WeWork will be cutting jobs this month. In a meeting on Thursday, co-CEOs Artie Minson and Sebastian Gunningham said the layoffs are part of a cost-cutting measure. So is WeWork poised to capitalize on the lessons learned from last week? Let me ask Bradley Tusk. He's founder and CEO of Tusk Holdings, which includes Tusk Ventures and Tusk Strategies. He has his finger on the pulse of VC, startups, and political strategy, so you can just talk about everything.
Yeah, we can just go. I'll just stay on the air indefinitely.
Let's start with the IPO market.
Yeah.
What have we learned from the likes of Uber, WeWork, for example, have had to shelve that, about this IPO market?
Yeah, I think we've learned a few things. So the first is clearly private valuations and public valuations are just not aligned. And I think the reason for that is, there are venture funds. We're early stage investors, so for us it's not as much of an issue. But if you're raising $10 billion, $20 billion, you're SoftBank, $100 billion, you can't write a check for less than $50 or $100 million, which means the valuation has to fit within that. And so as a result, private valuations were driving up and up and up, and the economics weren't really there to support it. So when these companies eventually become public, there's no real way to sustain that. And whether that's Uber at $72 billion and now down to, I don't know, it's like 45 or something like that, or WeWork from 47 to, I don't know what, 2 billion, 3 billion, 1 billion, whatever it would be worth right now. So that's problem number one. The second problem is private companies are staying private for too long. I'm a shareholder in Uber, and I've been an investor in Uber since 2011. I remember thinking in 2015, 16, why don't we go public? And Travis had all of his reasons as to why not. And they all made sense. But I think when a company is a private company for 8, 10, 12 years, by the time it finally IPOs, there's no honeymoon, there's no excitement, there's no pop, because we've been living with this thing forever at this point.
So when it comes to valuations, are the public markets becoming smarter than the private markets?
I think so. I mean, they're more efficient, right? Because the incentive is in the public market just to buy a share if you believe that it's a good value and that it will go up. Whereas in the private market, part of the incentive is I just have to deploy capital, right? You can't get your 2% management fee if you're not spending out the fund. So the incentives of VCs are often misaligned with where the incentives would be for public investors.
When you take a look at some of the companies, is corporate governance a bigger priority now than profitability?
Well, it's going to have to start to become not a bigger priority, but if you look at WeWork specifically, and Uber and Tesla and Facebook and a lot of companies, there is this problem now where you have such a lack of control of governance by VC boards that you have founders that can get too out of control. It's a very tricky situation, because if you are a VC like us, you have to invest in the crazy genius, because that's where the value creation happens, right? That's where these really, and look, Adam Neumann or Travis Kalanick or Elon Musk did extraordinary things, right? Disrupted entire industries, broke cartels, but at the same time, no one ever said no to them. And eventually their behavior got to a point where it was really out of control. And ultimately, the case of WeWork was catastrophic and harmful in Uber, and at various points based on how Tesla's doing, harmful there too. So you can't not invest in these people. But you also can't say, okay, when we're going to IPO, we'll just flip the switch and put in a seasoned manager, because that's what Uber did. And that hasn't worked either, right? You replace an innovator in Travis with a really good manager in Dara, but he's just a manager. He's not an innovator. He doesn't really inspire any faith in the future. And the market is very much reflecting that. So you've got to, I think it really comes on us, which is VCs have to say, we are going to be tougher, we're going to have higher standards, and we're not just going to, in order to win a deal, say yes to whatever a founder wants.
So do you have to see a path to profitability, or are you okay not seeing that for 5 to 10 years and hoping it'll come later?
Well, I don't necessarily have to see it for 5, 10 years, but I have to see how we ultimately get there without saying if we become the Amazon of X, then we'll be really profitable. Sure, anyone who's the Amazon of anything is going to be really profitable eventually. But yeah, I think the unit economics have to get better, and you have to pay more attention to that. I think growth is a little less of an absolute priority at all costs. And this notion of, hey, they're going to assemble, they're going to gather all this data or all this market share, and they'll figure out how to become profitable. If you can't tell me at least what theoretically the path to profitability is, we probably shouldn't be deploying capital.
So you've mentioned Uber a few times.
Yeah.
How big of a concern is AB5?
Significant, right? So Uber has said that they think it'll raise their costs in California by 20%. Let's say that they're exaggerating, it's really 10%. It's still in a business that already has negative unit economics, adding 10% more costs onto that, whether it's passed on to the customer, which then decreases demand, or just the company is bearing the cost of it. Either way, it's really problematic. But the other problem is AB5 is not just going to stay in California, right? So New York has already said they're taking up the bill. There's a hearing on it in 2 weeks. Illinois, New Jersey, every blue state is going to run with this issue. And if all of a sudden Uber is seen as a full-time employer in 20, 30 states with a lot of the population of this country, that's a really significant hit.
30 seconds.
Yeah.
Jewel, too little, too late?
Yeah, I mean, not just that. I think that their business model the entire time was, let's just max out on this one practice, knowing that it probably can't last forever, but we'll make as much money as we possibly can. I'm really curious to see if the early Jewel founders and shareholders were selling on the secondary market as these new valuations were coming in, because it was very clear that this wasn't a practice that the FDA was going to let go on indefinitely, yet they kept doing it anyway.
My thank you, Bradley Tusk, founder and CEO of Tusk Holdings. And that does it for this edition of Bloomberg Technology. And Bloomberg Technology is live streaming on Twitter. Check us out at Technology, and be sure to follow our global breaking news network at TikTok on Twitter. This is Bloomberg.